Imagine this for a second. It's 1998. You're sitting on your couch, eating cold leftover pizza, CNBC on in the background, and every talking head is screaming about the future of the internet. Your coworkers are quitting their jobs to join startups with names like superonlineworld.com. Your neighbor's dog somehow has equity in a tech company. And everyone, literally everyone, swears they're about to become a millionaire. So you do what any normal American would do. You FOMO in. You throw every spare dollar into shiny new tech stocks because they have .com at the end of the name. And for a while, you're a genius. Your portfolio goes up faster than college tuition during an election year. People at work are asking you for stock tips, even though you can barely operate a printer. Then the year 2000 hits, and your entire portfolio does the financial equivalent of falling down an elevator shaft. The NASDAQ drops nearly 80%. Companies vanish overnight. Money evaporates. The same friends who bragged about paper millions quietly go back to their 9-to-5 jobs and pretend they always knew it was risky. Why am I bringing up ancient history? Because the vibe feels painfully familiar. Fast forward to today, and that same electricity is back in the air, only this time the magic word isn't internet. It's artificial intelligence. People are calling it the next industrial revolution. Some say it's bigger than electricity, the smartphone, and the Krispy Kreme hot light sign combined. Others swear it's the doorway to the trillion-dollar future. And maybe it is. Or maybe it's the exact same bubble we've seen before, wrapped in a sleek new AI logo. Before we panic, let's step back and look at the three forces pushing this potential bubble, why the hype actually matters to your money, and how you can come out ahead instead of becoming the next cautionary tale. Right now, the fate of the entire stock market and your portfolio is basically being held hostage by 7 companies. You've heard the nickname the Magnificent Seven: Apple, Amazon, Microsoft, Alphabet, Meta, Tesla, Nvidia. Together, these 7 giants make up roughly 1/3 of the entire S&P 500. If you invest in a simple index fund, congratulations, you're already betting your future on the AI arms race, whether you meant to or not. These companies are throwing around cash like a toddler discovering vending machines for the first time. And the spending numbers are wild. Tesla pouring billions into autonomous systems and AI training. Apple quietly shoving 10+ billion into Siri upgrades. Meta dropping tens of billions on data centers and metaverse infrastructure. Alphabet rebuilding search with generative AI. Microsoft funding OpenAI like a rich uncle with an unlimited wallet. And Amazon shoveling over $100 billion into AWS server expansion. Altogether, more than $330 billion in 1 year. That's more money than the GDP of Finland, New Zealand, and Iceland combined. This isn't just investment. This is full-scale warfare, a technological land grab where the prize is nothing less than the future of work, advertising, automation, entertainment, and global dominance. And here's the part everyday investors don't realize. If these companies even blink during this race, if spending slows, if innovation stalls, if hype collapses, your index fund won't just dip, it could crater. So the real question isn't, is AI the future? It's, can AI grow fast enough to justify the insane expectations baked into today's stock prices? And that brings us to something far more uncomfortable. To understand why people are whispering bubble, you need to see the financial loop powering this AI boom. And yes, it's stranger than it sounds. Let's break this down in simple, everyday terms. Imagine you pay your friend $20 to wash your car. He then pays you $20 to wash his car. Then both of you brag about making $20. Technically true, but nobody's actually richer. Now scale that up to billion-dollar corporations, and you have circular financing, a loop where companies feed money into each other to inflate revenue, boost valuations, and keep the hype alive. Here's the basic structure. Companies like Nvidia design the chips. AI labs like OpenAI buy those chips. Data centers like Oracle and Microsoft buy the same chips. Those data centers rent compute back to AI labs, and Nvidia invests into those same AI labs. Round and round. Everybody records revenue. Stock prices go up. Nobody wants to ask uncomfortable questions. This loop makes the market look unstoppable, even though much of the cash fueling it is coming from borrowed money, debt-backed credit, and non-transparent structures like SPVs and joint ventures. That's a problem. Because if your entire industry is growing because you're passing money in a circle, that's not innovation. That's financial theater. It's one of the biggest red flags in bubble history, and it's happening again. But despite all this, the actual limiting factor making investors truly nervous isn't money. It's something most people have never even heard of. For the past few years, AI has been leveling up so fast, it almost feels supernatural. Images went from blurry nightmare fuel to shockingly realistic. Videos went from stick figure chaos to, did Hollywood make this? But here's the twist. AI is speeding towards something called the data wall, and if it hits that wall hard enough, the entire hype cycle could shatter. AI improves by digesting massive amounts of human-generated content, books, articles, videos, code, research papers, you name it. But there's a problem. We're running out of data. By 2027, AI models are expected to consume nearly all available high-quality public text online. That's centuries of knowledge, swallowed in just a few years. Once the data buffet is empty, improvement slows. Expectations fall. Valuations collapse. Bubble pops. It's the equivalent of teaching a genius child everything on Earth by age 9. So what's the solution? AI companies are scrambling to license private data sets, train models with synthetic data, use real-world interactions, and create AI systems that learn by doing instead of just reading. Is it possible? Sure. Is it guaranteed? Not remotely. This is why investors are nervous. A bubble doesn't just burst because people panic. It bursts when growth can no longer justify the price tag. And right now, AI expectations are priced like reality will bend to match them. Spoiler, markets don't care about your optimism. Let's finally answer the question everyone keeps tiptoeing around. Is this an AI bubble? Short answer, probably yes. But the long answer is where things get interesting. A bubble doesn't mean AI isn't real. It doesn't mean AI won't change everything. It doesn't even mean AI stocks are doomed. What it does mean is this. Prices are rising much faster than the underlying fundamentals can justify. And if you study bubbles, the housing bubble, dot-com bubble, Japan's asset bubble, they all have the same fingerprints. With AI, those fingerprints are everywhere. We've got overvaluation on a historic scale. Companies trading at revenue multiples that you normally only see right before something breaks. We have massive capital expenditure corporate spending so large it rivals the GDP of entire countries. We have circular revenue loops where money is passed around like a hot potato to make financials look stronger than they are. We have geopolitical pressure between the US and China pushing companies to scale at all costs. We have hidden debt buried in SPVs, private credit, and off-balance sheet financing. We have investor concentration where 5 companies represent nearly a third of the entire stock market. And yes, we have the greatest psychological force in finance, FOMO. Everyone thinks they're early. Everyone thinks they're catching the next trillion-dollar wave. And that's exactly how bubbles form, not because people are dumb, but because narratives become louder than numbers. Now, does that mean AI is going to collapse? Not necessarily. Markets don't move in straight lines. They lurch, they shake, they overreact, they deflate, they recover. What it does mean is the road ahead might be rocky, violently rocky before the dust settles. Think about the dot-com bubble. The hype was real. The speculation was insane. The crash was brutal. But after the crash, the survivors Amazon, Google, eBay became the foundation of the modern economy. AI feels eerily similar. The question is not, will AI win? AI will absolutely win. The question is, which companies survive long enough to actually reach the finish line? Most won't. A handful will. And those survivors will shape the next 50 years of global wealth. That's why smart investors stop trying to predict the winner and start positioning themselves to benefit no matter what happens. And that brings us to the only part of this conversation that truly matters, what you should do next. Let's talk strategy without hype, fear-mongering, or financial wizard cosplay. Here's the truth. Most people lose money in bubbles not because they invest, but because they panic, over-leverage, or chase hype. If I were in your shoes, here's what I'd focus on. First, stay invested, but stay diversified. Index funds still win long-term because the winners eventually replace the losers. Second, don't touch debt-fueled investing. Margin is the silent killer. It's how people turn small dips into financial funerals. Third, increase income. A raise, a side hustle, a new certification. This is the fuel that powers long-term wealth. Fourth, own assets that aren't hype dependent. Dividend stocks, bonds, cash reserves, precious metals boring is beautiful when bubbles pop. Fifth, don't chase AI lottery tickets. Pick stable companies with actual cash flow. Your index fund will eventually hold the winners anyway. Last, and most importantly, stay patient. Bubbles burst, narratives die. But over decades, innovation wins. Disciplined investors win. And AI, like the internet, will shape the future whether the market behaves or not. So stay calm, stay consistent, stay invested, and let the chaos work for you instead of against you. If you want more breakdowns like this, hit subscribe, drop a like, and let me know in the comments what bubble or trend you want analyzed next.